This is the study session on financial reporting and analysis and the reading on financial reporting quality. Let me make a few comments before we get to the slide deck. Look at those first 10 readings and remind yourself that we've talked a lot about things like assets and liabilities and equities and revenues and expenses and cash flows. And as good financial analysts, we've learned how to sift through those financial statements and identify parts of it that we like, parts of it that maybe we don't like, to try to evaluate whether or not this firm is either under or overvalued. Financial reporting quality adds another layer to us. When we look at these financial statements, what we would like to do is just simply assume that they are accurate, that they are transparent, that they are reflective of the economic activity of the underlying business. But sometimes those assumptions are accurate and sometimes they're not. So this reading is going to tell us a little bit about how to determine the quality level of those financial reports. All right, the first LOS asks us to distinguish between a couple of different types of qualities. All right, we're going to look at the quality of earnings, quality of cash flow, quality of the balance sheet items. But in particular, this first LOS asks us to distinguish between financial reporting quality and the quality of reported results. So this is an important distinction. Financial reporting quality relates to the quality of the information that is contained in the financial reports, including all of the notes. And this is a subjective evaluation. And really what we're trying to determine is, do the financial statements in their entirety reflect the condition of the company? The quality of those reported results, in other words, the earnings quality, relates to the earnings and the cash flow generated by the company's economic activities and whether or not they can be sustained over time. And that's really the key element of the earnings quality. It's one thing to have high cash flow, high net income, some high quality ratios, but as a financial analyst, it's our job to determine whether those are sustainable over time. We don't really want to recommend an investment into a firm that's going to have a blip where they're doing something like this and all of a sudden it goes up and then it comes back down. We want to know if those net incomes, those cash flows, if they are sustainable. How about a spectrum for assessing financial reporting quality? So notice we have a box here, earnings quality over on the left, financial reporting quality up at the top. And if there is low financial reporting quality, whether or not the earnings quality is high or low, what it really does is reduce the financial analyst's ability to make a valuation assessment of earnings. However, if the earnings quality is low, but the financial reporting quality is high, then financial analysts are able to assess those, but the low earnings quality, remember that ability to sustain is relatively low, that's going to decrease the company value. So what we're looking for, and what I suggested just a few minutes ago, is that we want financial statements that are accurate, that are reflective, that are transparent, and we want to find firms that have sustainable earnings. And so think that the goal is kind of be up in that right-hand corner, right-hand top corner. All right, let's look at the quality spectrum, and I want to start down at the bottom right where I list this here as fictitious transactions, which are made up stuff on the financial statements, all the way up to the top left where I'm calling this the quality is based on all of the rules of GAAP. It's useful for decision making, sustainability, and that the firm is generating adequate returns. So think of those as the two ends of the spectrum. Think of the top left as being, boy, these are perfectly created financial statements that indicate that this firm is operating at a high level of efficiency, all the way down to the bottom right, which is something that, boy, I'm not quite sure we can even believe any of the stuff that is reported. And there are a couple of subgrades in between those two ends of the spectrum, and we'll go through those in the next couple of slides. All right, so let's take an example here. Let's suppose that we have a company that experiences a decrease in sales. However, there is an increase in operating income, and this increase in operating income is caused by the effect of exchange rates. Now, of course, exchange rates are quite volatile. Sometimes they move in the company's favor, sometimes they move against the company. And what we do know about about exchange rates is that those changes are random, and so they're not predictable. Even though companies spend tons and tons of capital trying to estimate what exchange rates are going to be, and some companies are better at it than others, but clearly an increase in operating income without a corresponding increase in revenues because of exchange rate movements that are in favor of the company are probably not sustainable. All right, so where does that lead us? Where does that leave us in our quality spectrum? Sounds like we're creating these financial statements according to the rules of GAAP. They're useful for decisions, but are they sustainable? So let's just go ahead and say that these are of low earnings quality. All right, how about the next part, which is kind of like in the middle, where we're within the ranges of acceptable accounting principles, but our choices are biased. So we can either have aggressive accounting or conservative accounting. Aggressive accounting is a decision making that probably tends to make the current reporting period more attractive, probably at the expense of future reporting periods. And then conservative choices is probably just the opposite. It decreases the current reported performance, but maybe we'll make that up in future performance. So this is within the rules of accounting, but there are biased choices. And so when there are biased choices, the financial analyst really has to kind of uncover what the motivation is there, which ones are unfavorable and which are favorable, and then are they going to sustain themselves, or are they going to kind of revert back to being the opposite of whatever that first choice was. Now, here's the thing about biased choices. They might follow the accounting rules, but they probably violate the spirit of accounting. And this is an important lesson that I learned all the way back in my accounting theory class, is that you got really, really smart men and women who sit around and think about this all day. What is the best way to present financial data? And so there's probably not ever one thing like, we have to do it this way, and there's no deviations allowed. Of course, accounting theory allows for decision making and decision rules and some deviations. But if those deviations are systematically trying to make the financial statements more attractive, well, then they're biased. Of course, a great example is all the way back almost 20 years ago. WorldCom inflated its net income by capitalizing expenses. And this was to the tune of several $billion. How about almost 20 years ago as well, Krispy Kreme experienced some increasing revenue without any increase in capital when some regulators and some financial accountants found out that they were using some leases and some creative financial engineering and some synthetic leases to remove some of that equipment off the balance sheet. And so it sounds a little bit like this was within the rules of the accounting principles, but clearly this was a biased effort to fake out investors. Now, how about this concept of earnings management? These are deliberate actions to report earnings that are influenced by decisions that are made throughout the course of the creation of the financial statements. And so there are two ways to do this. Real earnings management, which means that the executives are trying to manipulate the real business activities. And some examples include deferring research and development costs to future periods in order to meet a current earnings target. That's a real earnings management, as opposed to accounting earnings management, which are really just changing decisions that we've talked about in those previous 10 readings, because, of course, the firm has choices in its methods of depreciation or valuations of inventory. So make sure you can distinguish between real earnings management and accounting earnings management. And let's skip over to the red under quality spectrum. This is stuff that we don't like at all. Non-compliant accounting. You remember back in 2001, Enron used these things called special purpose vehicles or special purpose entities. What they did is they put some assets in there, and then they issued some bonds against those, and then they pretty much lied to us about a bunch of other stuff. So clearly Enron got started down the path of non-compliant accounting, but I think by the end they hovered over there towards presenting fictitious transactions, which of course is what this Italian milk processing firm Parmalat did in 2004. They just made up stuff on the balance sheet. All right, how about an LOS that asks us to describe motivations that might cause management to issue reports that are not high quality? Well, how about to hide their poor performance? I mean, think about this. If you're the executive and it's your job to do things like, what's the goal of the business? Maximize shareholder wealth. How do you do that? By investing in positive net present value projects, by finding the optimal capital structure, by minimizing the agency conflict. If you fail to do all that stuff and you put out financial statements that reveal your failures, what you're telling the marketplace is say, hey, I'm a candidate to be fired. So of course, to hide poor performance is a great motivating factor. What complicates this a little bit is that financial analysts like us, we're out there making our own judgments about the companies. And so we release this information. So we say something like, hey, I think this particular company ought to have an earnings per share of $1 next quarter. And the company's thinking, oh my gosh, it's only going to be 80 cents. What can I do to make it $1 so I meet Jim's expectations? And then, of course, the other part of this is that executives, they get paid in terms of salaries and bonuses that are tied to things like performance, but they also are granted stock options, which are tied to stock price. So that there's an incentive, at least in the short term, because it's almost impossible to hide this over the longer term, say greater than a year. And then, of course, there's some penalties that might be imposed in violation of the debt covenants that we talked about in the last reading. What conditions are conducive to issuing low quality or fraudulent financial reports? All right, so what conditions are usually in existence? So there's the opportunity, there's the motivation, and the rationalization. And the opportunity goes back to the system of internal controls that we talked about back in our corporate governance reading, in which we said that we need to have a board that oversees this whole system of controls and corporate governance structure. And these board members need to be independent thinkers. They need to be smart people, and they need to be confident in their skill set. I'm reading a book called I Love Capitalism by the founder of Home Depot. And this dude talks about his experience on corporate boards throughout the years. And I'm so amazed and so impressed by his description of some board members who are really on top of things. They're experts in their field, but they're also able to relate to people. These leaders, it's one thing to be able to say, okay, I'm going to sell $100 worth of this good today, but it's another thing for a board to have the skill set to be able to increase the culture and the awareness that it's more than just making the sale, it's making the customer happy. And this is the one thing I learned about reading this I Love Capitalism book. It's an awesome book. How about motivation? This is what we talked about just a few minutes ago. Managers and executives feeling pressured to meet criteria, maybe just for personal gratification, but also for bonuses and for future financing. And then, of course, there's always the rationalization that, oh, I'm doing this for the good of the company or for the good of the shareholders. And so that's a concern there. So remember those three conditions: opportunity, motivation, and rationalization. Now, how are we going to avoid? How are we as financial analysts going to be able to determine whether or not this reporting quality and the earnings quality is in place? Well, we're not alone. We have some other people to help us out. We have regulatory authorities. We have all sorts of government and industry leaders who know what we're doing, and they have the authority to come in and say, you need to follow this set of rules. There's also a lot to be learned from the auditors, from the financial accountants who come in and they look at our financial statements, and then they do the audits themselves and they say, okay, these are the things that you need to be concerned about. There's also the management commentary, and then there's the responsibility statement that we emphasized back in that corporate governance reading. Here again are the auditors. So the auditors come in and they say, all right, we've looked at the financial statements and we're going to give them a great rating, or we're going to give them a poor rating. And so the auditors make certain that all of the information that's provided to the shareholders and regular investors meets with the accounting standards. And then here's one that I like a lot, that executives, they regularly go to the capital markets, and so they need the services of people like investment bankers and commercial bankers and lawyers and insurance companies. And so these people come in, these expert men and women come in, and they say, okay, if you want to borrow some money, or you want to recapitalize, or you want to do all this stuff, show us your financial statements. And if they see low quality of either reporting or earnings, well, that's going to affect the outcome of the reason for which they were hired. All right, so three mechanisms: regulatory authority, auditors, and private contractors. Describe presentation choices, including non-GAAP measures. Oh, this is fascinating. That could be used to influence an analyst's opinion. All right, so remember in our behavioral finance reading, we talk about how the frame is really important, that if an event or a decision is framed in a certain way, it can influence the opinion. So an analyst has to be clearly aware that the executives may try to frame the financial statements so that the analyst has a much higher opinion of the earnings quality and the financial reporting quality. All right, so if the company is going to use any kind of a non-GAAP, they need to tell us about it. And not only does the firm have to tell us about it, but it has to display the most directly comparable GAAP measure. Comma, they also have to include an explanation in there, or for why that the business is using this non-GAAP measure. And the international standards are similar. How about accounting choices? How do the accounting choices help influence an analyst's opinion? And so there are things like recognition of revenue. There are things like uncollectible account estimates. There are things like those deferred taxes. We just spent an entire reading on deferred tax liability and deferred tax assets, depreciation methods and inventory methods, and capitalization of expenses. So this is why we go through those previous 10 readings, so the financial analyst is an expert. I don't want to say that they become accountants, because we really don't want to become accountants, but we want to be able to use the language of accountants and understand the accounting theory behind all of the accounting choices, so that when we observe that a firm has chosen LIFO, or a firm has chosen modified accelerated cost recovery system depreciation method, that we are alerted to possible influences of our decisions. How about some signs of manipulation? This sounds like a great exam question. Revenue growth that's out of line with the competition. I mean, clearly, if a company like Walmart is increasing by 5% and a company like Target is increasing by 5%, and then all of a sudden Jim's retail firm increases by 30% for a year or a couple of quarters, boy, that sounds an awful lot like that could be manipulation. Turnover ratios, absolutely. Inventory especially. Receivables, just a little bit. Another thing to be aware of, remember when we did all that cash flow stuff, we went from net income, and then we did a bunch of other things like add depreciation and move all the way to free cash flow. So we need to make sure that we reconcile the net income as reported by generally accepted accounting principles, and then the cash flow from operations. Remember, those two numbers are probably not going to be the same number, and sometimes they can be very far apart. But of course, there needs to be reasons why they're not nearly the same number. Barter or related transactions, capitalization and depreciation. Here's another good one. Fourth quarter earnings patterns is not supported by seasonality. I like that one a lot. And then if the firm has non-recurring items occurring pretty regularly, what does that mean? Non-recurring means that it's probably not going to happen anytime soon. But if there's a series of these non-recurring items, that's probably a warning sign of manipulation. Here's an example of the Moda Group when they shipped almost $1 million worth of the product to a distributor, and the distributor had some rules that it could sell them or it could return them, and then Moda ended up reporting something close to $500,000 that was out of line, and so they had to report this. That takes us to the end of financial reporting quality. Just one more reading in FRA, and then we can move on to investment stuff.